And my two sets of comments are having to do with, first of all, how this all impacts young people, people in their 20s and 30s. It's a topic I've been writing about for over 15 years now. And I was asked to talk a little bit about the impact of credit card debt on young people. And I wanted to sort of go through a poll in 1991. Money Magazine and Yankelovich did a poll that found for the first time young people feel they're not going to live as well as their parents. In 2000, 10 years later, Time and Yankelovich did the same poll, and again, the vast majority, 65%, said they don't think they'll live as well as their parents. And while the same poll hasn't been done last year, MTV and AP did a poll, and they found that the #1 source of unhappiness for people in their 20s and 30s are financial issues. So that's more than their concerns about jobs, school, their parents, which is good news for parents out there, failing, death, or even the evils of the world. So young people are really, really concerned about their finances. And the question I was asked was why? And if you just look at the statistics real quickly, incomes from people 25 to 34, after you adjust for inflation, on average are 10% lower than they were in the early 1970s. And this is including men and women with college educations, without college educations. On average, that whole group is earning 10% less after you adjust for inflation than the early 1970s. And of course, as we all know, the debt loads are dramatically higher. We have the average college student graduating with $20,000 in student loans, and according to PIRG, $2,600 in credit card debt. People ages 25 to 34, 65% have credit cards, and 70% are carrying a balance from month to month, meaning they're not paying it off in full. Maybe they're making those minimum monthly payments. And I think one of the big things I've noticed in the last almost 2 decades is attitudinal changes. You know, I speak on college campuses. I've been to community colleges, Ohio State, to Harvard. And across the board, I feel like young people, people who are right out of college in their 20s, view credit in a very different way than people did 20, 30 years ago. At Harvard, great school, kids were saying to me, well, I have my savings account, and I have my checking account, and then my credit account, and I draw from each of those without even realizing that a credit card is a loan. I've had people say to me, I got to college, I didn't have a job, I didn't have any income, and yet I got a credit card. And it's a high-rate credit card. The average for student credit cards now is 14%. And of course, this sounds frighteningly similar to the subprime mortgage crisis. You don't have a job, you don't have an income, and you're given a loan that has a high rate. It's sort of not a great scenario for success. Also, Congresswoman Maloney had talked about the idea of limits. A lot of people, young people say to me, look, I got a credit card, it was for $500, and the credit card company keeps raising the amount, and I tell them, please don't do that. But every time I turn around, I can borrow $1,000, $2,000, $5,000. I don't even want all this credit. And of course, the issue of, years ago, you pull out a credit card and you go to a restaurant, it's really embarrassing when it's declined. Well, that doesn't happen anymore because the banks have figured out, it's better to not decline the person, just give them a bigger loan, give them more money, and charge a higher interest rate for it. So there's a big attitudinal change that I've personally seen. And of course, when banks have been aggressively going after college students, I think a lot in the last decade or so, the hope was, in many cases, that parents might come in to foot the bill if they have a college student who gets into trouble. And of course, now that parents are seeing their 401ks decline by half, you're suddenly in a situation where many parents are not in the frame of mind, nevertheless have the money to pay back their students' defaulted debts. So we see a larger chunk of young people using a larger chunk of their after-tax income to cover monthly bills. In 2000, it was 20% of after-tax income. Now it's 25%. And this really understates the problem because this data, which comes from the Federal Reserve, looks at what people pay each month. And they're looking at, in many cases, we know a lot of people, particularly younger people, pay just the minimum monthly payments. So you're saying they're putting 25% of their monthly income toward payments. Well, actually, it understates the problem because if they're only paying the minimums, imagine if they were paying more than the minimums. That would be a bigger chunk of their income. You know, the other reasons why young people don't think they'll live as well as their parents, you know, you look at everything from housing, a larger chunk of their salaries are going to housing. 1 in 4 young people, 18 to 34, have no health insurance. It's the largest cohort. 18 to 35-year-olds are the largest cohort that don't have any health insurance. And this was all before the recession hit. All this information took place before we saw this major economic firestorm. And now that young people are graduating from college and they have high debts, both student loan debt and their credit card debt, and they can't get a job, they're pretty worried that they're not going to live all that well. So those are sort of my general comments, and I have a whole bunch of technology-specific comments that we could talk about maybe during the Q&A.